That's it. Because I can't promise tomorrow. I can't promise it. But what I can promise you that if it goes how I think it's going to go, you're already going to be happy, but you're going to be incredibly happy, right? And so,
What's up, everybody? Mason McDonald here with Dan Haberkost, and we have another great episode for you guys today on the Big Picture Blueprint. But before we get into introducing our guest, Dan, how are you doing today?
I'm good, Mason. It's December, doing quite a bit to prepare for next year, and I really think of December 1st as being the start of the new year. So it's a busy month.
Yeah, I feel the same way. We'll have an episode that comes out right at the end of the year that'll probably talk a lot about our plans. And one of the challenges in this business and one of the cool things about the podcast is we interview a lot of really interesting people with a lot of really interesting strategies. And while this strategy is not sexy that our guest has today, it is really cool and really profitable. So,
yeah, we had Kevin Bupp on today, and this was fun because Kevin's podcast was one of the first I ever listened to. It's the Real Estate Investing for Cash Flow podcast. I remember listening to him back in 2017, 2018 when I was just getting started. And Kevin has been in the business for 20 plus years. He lived through '08. He talks a lot about recovering from '08 and getting into mobile home parks and ultimately parking lots. So Kevin is the owner and founder of Sunrise Capital Investors, where they target exclusively mobile home parks and parking lots. And so we do a deep dive into both, what's working today, how they're finding deals, what those deals look like, and how he's doing things differently this time around after living through 2008. So this was a really fun podcast from somebody who's been in business a long time. And so a lot of insight that's applicable to really any real estate investor. And I hope you guys like it. Let's bring him in.
all right, Kevin, how are you doing today?
I'm doing great, Mason. How are you guys doing?
Not so bad. Well, we're excited to have you on the show, but I was reading through your website and I saw some stuff I enjoy, which I see you're a bourbon aficionado. So if you were stuck on a desert island and you had 2 bottles of bourbon that you could bring with you, what 2 bottles would you bring?
Man, that's a really tough one because I love trying new things and depends on what my palate's doing. But damn, so that's a tough one. But I will say that, the ones I'm going to give you are actually pretty mainstream, but I also think they're fairly underrated. One is Old Forester 1920. Big fan of that one.
Perfect. Great bottle.
And then the other one, again, which I think is incredibly underrated, is that Wild Turkey Rare Breed.
Okay. There you go.
Yeah,
everyone.
It's a barrel. It's a barrel strength. Well, it's not the old school. I think a lot of people kind of they have the misconception of Wild Turkey. It's been around for a long time. They remember probably seeing a bottle of their grandfather's like liquor cabinet or something's dusty. It's and a lot of the Wild Turkey variations are the low price, and everyone always just assumes if it's low priced, then it's probably not all that great, right? But the Rare Breed one, I think it's about $50 bottle, but I put it up against any like $100, more rare bottle. It's a great one.
Absolutely. And it's all about the experience and what you enjoy. Wild Turkey 101 is a great entry bottle. Old Grandad, super cheap, and it's a great bottle of bourbon. But unfortunately, this isn't a show about whiskey because otherwise we would talk about Scotch and we would just insult bourbon the entire time. No, Kevin, we're really excited to have you on the show. And for Dan and I have been listening to you for a while, but do you think you could give just a brief overview of what you're doing today in 2024? What does your day-to-day look like? What businesses are you in? What investment classes are you in?
Sure. Yeah. So I'm the CEO of Sunrise Capital Investors. Sunrise, in a more formal state, the brand has been around since 2014. So just over a decade now. I've been a full-time investor for over 20 years, but Sunrise really has 2 primary focuses. The one being mobile home parks. We've been buying mobile home parks. I've been buying mobile home parks since 2012. Again, underneath the Sunrise umbrella since 2014. So mobile home parks is our primary emphasis, but we also have a second vertical that we spend time in, and that's parking. Lots of parking garages. Majority of our portfolio is made up of mobile home parks. I think we're in 17 different states at the present time, but we do have a number of strategically located parking assets throughout the U.S.
Okay, so you got into storage mobile home parks before they were all the rage and kind of the
Before they're the cool thing.
yeah. So that's cool because it reminds me of a lot of what we do with land, where from everything I hear anecdotally, it was very fractured and inefficient. It wasn't consolidated the way apartments tend to be, at least in the major metros, and it creates an opportunity. So is that the same reason you've gone into parking?
For the most part, yes. Yeah, for the most part, that is an accurate statement. It is very fragmented, has not been consolidated, and it's just there's not as many parking assets that check all of our boxes. We're very particular, but there's also not a lot of there's competition, but it's nowhere near if you had to compare it against one of the more consolidated asset classes like multifamily. I mean, like it's completely other end of the spectrum as far as competition is concerned.
So, okay, I definitely want to get into both of these, but let's start with parking because going into this interview, I was curious, is it one of those niche industries where there's a couple big players that you've never heard of that own everything? It sounds like that is not the case. And so if I'm correct there, tell us a bit about how you go about sourcing deals, what you look for, both in an asset you want to buy and avoid, and just give us a little background because I've never invested in parking.
Yeah, as far as from an ownership perspective, they're the largest owner of parking is municipalities. So locally owned by municipalities. Everyone's parked in a municipal garage or parking lot, and so like they are the largest owner. And second to that, there's some institutional groups. However, I would say that the institutional groups that have large holdings, most of their parking is by default of having large office holdings in downtown CBDs, and so just by default, if they own office towers and New York, Boston, Chicago, you name the major market, there's a parking deck or a parking structure associated with that, and so institutional groups do have a large portfolio and a large piece of the asset class. However, most of what they own isn't actually what we would typically consider buying. Most of theirs is purposely owned because they probably own something that that ultimately needs parking. Again, office, mixed use, condo tower, something along those lines. And so for us, it's like we truly look at probably 100 deals to find one that checks all the boxes. And over the past 4 years, we've bought one a year, and we've looked at a lot this year. We're about to close on one here in a couple of weeks. It's in Charlotte, North Carolina, and I'll give you the details in this one because it will give you a better understanding of what checks all of our boxes and why. This one is literally in downtown Charlotte, a stone's throw away from the Spectrum Center, which is where the Charlotte Hornets play. I mean, when I say stone's throw, it's the closest parking garage. I've got a crappy arm, and I could still throw a stone to hit the front door, main entrance of it. So it's an 800 space parking garage, or 802, I think, spaces to be more exact. I think it's 7 or 8 stories. And basically, for us, the demand drivers, where are the parkers coming from first and foremost? Because what you'll find is a lot of parking that's located in these downtown districts, probably 80% of it, probably originally derived from office parkers. A lot of times that's probably why it was built. They get transient parkers, they get folks going to maybe courthouses or maybe some nighttime traffic if there's bars and restaurant and entertainment nearby. But a lot of parking garages across the country, 80% of it was derived from office, which I have no interest in. I hope the office comes back, but I think where we see it today is about as good as it's going to get in most markets across the country. So I would never buy an asset that had to rely upon the office market coming back to better than what it currently is today. And so for that reason, that eliminates a lot of what we look at. A lot of the stuff that comes across our desk has a component of office or a large demand from office parkers, which you look at the last couple of years has trended downward, or it's trended down for the last 5 years. And I don't know how to make that trend come back up. I can't fix that problem. So we basically have to have 5 very diverse parking drivers. Courthouses are great. Government buildings, courthouses, what have you. Nighttime entertainment, daytime transient traffic. So people are going there for the daytime for various purposes, whether it be, restaurants, visiting friends of theirs that live in multifamily units or condos downtown, what have you. You got sports and entertainment, whether it be NBA, NFL, NLB, music venues, which are typically kind of doubled as much. And then you got office. The office for us, it literally can't make up more than like 20% of the overall demand of the garage. And the other ones have to be fairly even keeled. The other 4 demand drivers have to be even keeled so that we know that in the event something goes awry in one of those particular areas. So for example, COVID, not to shut down offices, but a lot of areas, COVID for a period of time shut down the government buildings. So, we want to know that we have a diverse demand driver of parkers. And so it just eliminates a lot of what could be an investment opportunity for us. It just kicks a lot of them out of the bucket. So the one in Charlotte, Charlotte actually has one of the most thriving office environments. If you want to look at the office bucket, Bank of America, their headquarters, it's a banking hub. Bank of America headquarters, Truist headquarters, they're literally downtown. So our parking garage actually connects to the Bank of America, high rise, and they're 100% back in the office. Truist has required all their folks to 100% come back in the office, at least at their headquarters. And so, but even with all that, the portion of our parkers there is less than 20%. We get a ton of our parking from transient revenue as well as the Spectrum Center. Spectrum Center, they're putting literally $240 million into renovations. They're halfway through the renovation project now, so that's not going anywhere. It's not going anywhere anytime soon. And so, and Charlotte's very much a vibrant downtown. It's uptown, but it's actually downtown. They classify it as uptown, but their downtown is uptown to them. It's a very vibrant downtown area. I was just there a couple weeks ago, and there are workers everywhere. So it's very, very different than that of go to New York City or go to the central business hub of Boston or any of the other markets that were really shut down during COVID. Or San Francisco is probably a really good one to use or Portland, it's like crickets, right? Even still today, Charlotte's thriving, it's vibrant. So anyway, just some things that we look for in this particular deal. It's distress. Anything we bought has had, just like you guys look for, the mismanagement, opportunities to create some better efficiencies. So this one was unique. This one was unique in that it's one parcel, and on this parcel is a large parking garage. It's its own structure, but it has kind of touching walls with a large office building, and then also a hotel. All of them cross collateralized underneath on the same parcel, underneath the same loan. Well, guess what? The office has had significant vacancies. They had one. Wake Forest was one of their large tenants, and literally occupied like 70% of the building. And they're moving. They moved, and so it threw this loan into default. The hotel has done great, but the office has really thrown this thing into a tailspin. It's cross collateralized, and so the parking's the only thing that's really worked really well there. And so we're buying this deal, and we're basically getting the plat revised and creating individual parcel IDs for it. We've got an office, the guy that's actually taking the office right now, and he's converting it to 240 apartment units. A really well-known developer that's done this many times. And then we also have a buyer that's buying the hotel. So they're going to buy that. We'll take the garage, and the garage has performed quite well, but we get an incredible deal on it with a lot of upside, just given the fact that the entirety of the deal is distressed. So it's in great shape. It's been well maintained. And even during receivership, it's performed quite well. And as you guys probably know, when things are in receivership, they're not really managed all that great. It's kind of just a set it and forget it, wait till a new buyer comes along and they can take over the mess. So anyway, I'll stop there. That was a lot, but I'll stop there and let you guys ask any clarifying questions.
Oh, very cool. I think that lays out your criteria really well. And that's an interesting deal. A little bit of, our world with the replatting it and severing off the asset that you want. That's cool. So the big question is, you talk through your criteria, like you said, very limited on the amount of assets across the country that fit this. And so how are you going about marketing or looking for these deals? Is it all brokers? Do you have, a set metro, size in certain states? Is it just anywhere if it's a large enough population? How are you finding these deals?
Yeah, it's a great question. And it's definitely, there's not just one way that we found to be the best. We tried to take our old school approach, which is databasing all the markets we'd like to be in and doing direct mailers. And while that's proven successful on actually two of 5 occasions, it's just very difficult to database a lot of these things. For example, like the one in Charlotte, it'd be hard to database them because it's literally attached to an office and a hotel. And so it's just, and it's, a lot of these are owned by institutional groups. And so trying to get to the actual decision maker, it's very difficult. So we found that that's proven successful to us, but not on a large scale. Brokers, there's really no specialized brokers on this asset class. Like there's one CBRE group. I think they're headquartered out of Texas somewhere. They're the only ones that actually have a arm or division that specializes in parking assets. However, if you really dig into their business model, most of their transactions revolve around large office owners that, again, happen to have parking assets. And so a lot of what they come out on the market with, this really don't fit our criteria. And so what we have found to be the best is the industry is pretty big, and general nature. There's a lot of technology companies, that have software. There's lots of consultants within the industry that work with municipalities, that work with private owners to help them drive efficiencies in their business. So there's a lot of folks that work in the industry that are connected to various property owners across the country. And so we've found the best with building relationships and getting known within the industry as the guys that, because there's not many of the guys that are actively looking for parking. And so just tying ourselves together with these different vendor groups, building a relationship with them, and then just offering them some type of incentive to bring us leads has been the best way for us to really get our toe into the industry. But it's been hard. It's been a 5 or 6 year endeavor to even get to where we're at today, and we've only bought basically one a year for the last 5 years. So it would be very hard to build a big business out, is what I found. More often than not, the deals just don't check all of our boxes. And so originally we thought there'd be an opportunity to go buy $2, $3, $4, $500 million worth of parking. And I'm not saying that's not possible, but it would be very, very difficult to do, to find quality assets, at least with our criteria, that check all those boxes, and build a large portfolio out of it.
I gotcha. And what's nice about that is, since the data is messy, since there's so few opportunities to just be able to go out there and find it, it makes it so where, there's probably a lot less competition, which is nice. But on the operation side of it, whenever you get these asset classes, I have to imagine the way it's managed is antiquated. There's probably all sorts of different systems or no systems. I know, at least like in the office space, I imagine there's a lot of people that have, they pay monthly parking rent. My wife worked in Austin for a little while, and we had to pay $300 or $400 a month for her to park in one spot in like 1,000 parking space garage. So when you guys come in, what operational inefficiencies are you seeking out to just improve what the product's going to perform like?
Yeah, no, that's a great question. Technology is a big one. You'll see a lot of these garages that they just have antiquated technology. There's for example, the Charlotte garage. It's right across the street from this Spectrum Center. NBA games. Like the day I was there last week, Iron Maiden literally had a sellout show there, and so this garage fills up. But guess what? When you guys we've all been to an event to where when it's time to go, we're ready to get the hell out of there and go home, right? And so this garage, it literally, if you happen to be one of the guys that came late and you ended up on the 7th or 8th floor, it's, with their antiquated, software that they have running this garage, it literally, you're probably sitting for an hour waiting to get out of the garage. And that sucks, right? That's not fun. That's a bad experience. And so little things like that, just bringing up the latest and greatest technology and automations is a big one. Like there's license plate recognition technology now to where you could run an entire garage and not have like the arm, the gate go up and down. I mean, to where it's literally capturing license plates and charging folks accordingly. Another big one is pricing. We see a lot of operators that they've been running it the same way for many, many years. I mean, I'll give you another example. We bought a garage in our backyard here in Clearwater Beach, Florida. And it was actually owned by the city of Clearwater. Half was it was a partnership between the city and a private developer that built the garage. But really, it was all the major decisions were by the city, and municipalities just typically aren't the best business people. Well, when we bought it, they had fixed rate parking. It's 700 spaces. They had fixed rate, and there's limited parking on the beach already. That's why they put it there, and it still didn't completely solve the problem of parking there. They're charging $3 an hour, fixed pricing. They made no adjustments for busy times of year, 4th of July weekends. I mean, special events. Whereas everywhere else on the beach, it might be, it's $6. Number one, it's $6 an hour on average. But then when special events are occurring, they basically adjust the pricing accordingly. It might be $20, $30, $40, $50 flat fee. And they're able to turn 2 or 3 cars in that same 24-hour span of time. And so the city was leaving just a ton of money on the table. And it really was just a pricing change. We went in and literally changed the hourly pricing from $3 an hour to $6 an hour, and then implemented a software that allowed us to adjust it on the fly during special events or during special holiday weekends and things of that nature. And just doing that alone, I mean, literally, we didn't lose any parkers at all. Parking's inelastic, meaning that like if you drive to the beach and you got screaming kids in the car, and everywhere else is $6 an hour anyway, you're not going to not park there because maybe you parked it before it was $3 an hour and now it's $6 an hour, but everywhere else is $6 an hour. You're going to park in that garage. In fact, even if it was $8 an hour and you've already got screaming kids and there's a parking spot in that garage, you're pulling in and getting the kids out of the car, right? Like you're not going to drive around in circles trying to find something for $2 less an hour. So for that, just minor adjustments like that, just operating the business more efficiently. And outside of that, I'd say the last one would be, so we're vertically integrated with our mobile home park business. We have internal management. We've got staff across the country. Parking, not so much. We do have an in-house asset manager, but we outsource the parking. There's lots of very professional, large, any major market like Charlotte, there's no less than 6 or 7 big parking management groups that have advanced technology. They've got the infrastructure in place. They've got the systems and processes that would take us many years to build, and still, even though we probably wouldn't be to their quality or scale. And so we basically, find the best operator, find the best incentive for them to do great. So we put different types of kind of kickers in there once they've reached certain thresholds on a monthly or quarterly or annual basis. And so it's just being a strong asset manager with that management company, like the current management, the Charlotte Garage, the current management company that's in there. It's interesting. It's a local group. So you'll find this in some cities. It's a local group. I'm not going to name their name, but they own a parking management company. It's an old family, been in the business for like 40 or 50 years. They happen to also own a lot of parking in Charlotte, a lot of surface lots, and in a few of the garages, mostly surface lots in and around the stadium. There's a little bit of a conflict of interest there. They literally own a surface lot right behind our parking garage that they also manage. And so it's more beneficial for them to fill their lot first and direct people towards their lots than it is actually, fill the one that they're third party managing. Right. And so I think there's inefficiencies just for that point alone. And so bringing another operator in with a fresh set of eyes that doesn't have an immediate conflict of interest is also going to be a big value add for us.
So that sounds very similar to multifamily investing. Of you come in, you improve the customer experience, and you increase top line revenue, and that makes things a lot better. What I'm hearing similarities to as well is, it's like Uber, of their surge pricing whenever there's events and demand and everything like that.
That's exactly what dynamic pricing. Yeah, surge pricing. You got it. Like you hit that one on the head.
Oh yeah, and you get it. And since there's such scarcity, you have to park there, regardless of what it costs. It's sorry, that's what the price is. But how much government regulation is involved with some of the pricing dynamics that you guys are using? And have you seen any local, municipalities or governments in states or cities you operate in try to, regulate how much you're charging for parking?
No, there are a few markets that's the case. Chicago's a big one. New York City's a big. The ones that you would expect. San Francisco's a big. Like the ones literally that come top of mind probably for all of us are the ones that we won't even go near. Chicago's got the most egregious, I think, parking tax of all. It might be it might be higher than what it was. Literally 25% parking tax to the parking, and that doesn't factor in real estate tax or anything else. Literally just a blanket 25% of revenue parking tax that they charge parking lot operators. And I look back historically, over the last 30 years, it started at like 12% and has since more than doubled in the last couple of decades. It's like, how do you control that one? How do you manage that variable? I don't know the answer to that. So for that reason, we stay away. We stay in very, owner-friendly markets that are, typically friendly to landowners and property owners, and don't try to put their hand into the regulatory bucket with how things operate. So all the markets we own in Phoenix, Arizona, this one in Charlotte, Wilmington, North Carolina, in our backyard here in Clearwater, Florida, and then also in Raleigh, North Carolina. So we're in states that for the most part are fairly red and are very landlord friendly.
Gotcha. Okay. It is really interesting, Kevin, on that whole, this is a little bit of a tangent, but it's applicable. I remember when I first started investing in Colorado in 2018, the laws were becoming more and more like California for everything from constructing real estate to managing it. And as much of a pain in the ass as that is, there's an irony in that it drives up the prices. And I thought, great, if you want to make this like California, then all of my houses and duplexes will be worth far more. And so it's kind of funny where part of me, there's a line there, and if it gets too bad, it becomes a problem. But overregulating restricts supply and makes it more expensive to manage, and ultimately pushes up the price of the asset. So there's kind of an irony there. But anyways.
Well, yeah, it scares certain investors away, right? Like, and so if you can learn how to actually operate and navigate that, the nuances of that market, then I mean, we own parks and mobile home parks in New York State, and New York passed a statewide rent control policy, and it became. I mean, it's still today it's the most egregious rent control policy that exists. Hopefully, no one uses that as a basis to design their own from, but. We sold, and the guy that we sold to, won't name names, but like he's now the largest mobile home park owner in the state of New York. He's operated there for not parks, but he's operated other assets. He was born and raised in Rochester, Syracuse, and he got into parks 7 or 8 years ago. Felt as though he understood the regulatory challenges that exist in that state, and decided that he was going to take advantage of basically a lot of operators moving out of that market. And so he literally went from owning like 5 or 6 parks to he's got over 100 parks now. He literally is the largest single mobile home park owner in the entire state of New York. But again, his claim is that like, hey, like I understand it. I don't like it, but I understand how to operate, understand how to navigate all the nuances that exist on the regulatory side of things. And I don't know how well he does, but like that's kind of his stick. Like, hey, I'll buy, get the right price. I can make this work, and I'll deal with all the other headaches associated with it.
Yeah, interesting. Yeah, so. On that note, that's a good transition. Let's talk mobile home parks. So, of course, you started a long time ago in the space. It was less efficient, less consolidated, and it's become well known, right? So, how much has some of these bigger players coming into the space affected the business? Are you still able to find, mom and pop owners and opportunities? Have you had to, move markets? How has that whole space changed?
Yeah, I mean, it's definitely become more consolidated. There's very little supply coming on the market, if any. I mean, it still has a diminishing supply in the grand scheme of things. So, more parks, go away or disappear on an annual basis due to redevelopment than new parks that come online. And so obviously more demand, less supply, it creates a major imbalance. And so there's good and bad. I guess the bad would say that, the bad is that it's just more competitive landscape for nice quality parks and great markets. Especially if you're competing against a group that's got a cheaper cost of capital. Like I can't change, the cost of our capital. And so therefore in certain instances, I can't pay as much. I just can't, even though our business model is exactly the same, I can't pay as much for a property. And so that's not great. However, on the flip side of that, being that the institutional world has come into the space, it's gotten a lot more attention. It's also, increased the overall value and perceived value of the mobile home park sector. Cap rates they've literally been trending lower than that of multifamily for like the last 2 years. I mean, Green Street data, even at present time, Green Street data, I think mobile home parks across the board are trading on a sub 5 cap still. It's crazy which where debt's at. That's just insanity to think about. And so that's a benefit for those that if you can still squeak out good opportunities in great markets, especially ones that are a little bit more of a heavy lift. A lot of institutions, they want to buy stable product. They don't want to, go in and do massive turnarounds. They want to be able to deploy a lot of capital easily. That's it. Like that's their name game. And so, even though there's more competition in the space, there's a lot of folks that aren't great operators. They might get into the space and realize that it's a little harder than what they thought. And so there's always opportunities. You just got to look a little harder today to find them. But again, back to one of the benefits of having these institutions here is that now there's an opportunity when we go to sell in the event, let's say, hey, we want to roll up our portfolio in 10 years, 15 years and sell it all in one fell swoop. There are plenty of capitalized buyers that can actually do that and can do that at a premium. So at a compressed cap rate and an overall premium. Whereas 12 years ago, 13 years ago, that wasn't the case. If you built up a big portfolio and you want to sell it, you're going to be piecemealing it. You might be able to pair 2 or 3 together, but there just weren't any big groups with deep pockets of money that could take an entire portfolio of 100, 200, $300 million off your hands. So again, pros and cons. You learn to adapt, right? As with anything, you learn to adapt. We've still found some great success over the last couple of years. Last year and this year, actually 2 of our best years that we've had as far as just amount of deals acquired, great bases. We've been able to take advantage of some of the distressed, not distressed properties, but distressed situations, that some folks have found themselves in. And so it's still been very good to us. You just got to work a little harder, which I'm okay with.
Sure. Yeah, no, I like what you said about pros and cons of everything, because this is true of every market. And I wanted to touch on the cost of capital comment, because I see this a lot where, well, of course, some of the big institutions can get money cheaper, but beyond them too, I'm in San Diego, and there's a lot of foreign buyers that come here and buy, prime beachfront property for cash at these absurd prices. And a lot of people look at that and they don't get it. But that person's situation, what they're looking for might be different. If you're in China,
Right.
you're just trying to get your money out of the country into what you think, the most stable real estate and the most stable country in the world, at least that's how they perceive it, then maybe a 3% return is fine if you feel like you're not losing money like they are potentially.
That's right.
China. And so do you run into competition of that sort of buyer in mobile home parks?
I wouldn't say it's that type of buyer. I can't say that maybe some of the capital that these institutional groups or larger groups have is maybe it's like a sovereign wealth fund or something like that. So I think there's various sources, pension funds, things like that. I don't think it's not all lumped into one bucket. So I can't say like that's the exact type of person we'll run into. I would say on an individual level, not so much, because this is different than them saying, hey, I got $5 million. I need to go park it into something just to get the money out of the country. A single family, buying a beachfront single family home, that's easy. Like it compared to a operating business, right? Where it's got a lot of moving parts to it. Maybe potentially easier to lose money because really the value on the mobile home park for the most part it's going to be on the operating business, whereas the value on that beachfront home is the land that it actually sits on, and that's not normally the case with the mobile home park. And if you run the park really bad, it can go from a $5 million asset to a $2 million asset. Whereas you could just let that beach house sit vacant, it's probably still a $5 million asset if that's what they paid for it.
Yeah. Okay.
So, Kevin, I guess with both of these asset classes that you're investing in, something that comes to my mind is it's always the highest and best use of land. With parking garages, sometimes I have to imagine that it might be really interesting to do multifamily there, and that's what the city wants, and that's what the city demands. Or with a mobile home, doing a stick-built single-family development project like that. With there being such limited supply for the two asset classes that you're approaching, how often are you looking at deals? I mean, you've got this interesting one in Charlotte, obviously, but how are you guys potentially pivoting your strategy to go after potentially raw land and do a development project, or a redevelopment of an office building or something like that? Just looking 5-10 years in the future with your business model.
Yeah, redevelopment's not so much as far as us, developing a mobile home park from ground up or even a parking garage from ground up. That's just not our forte, not our business model. And most of the mobile home parks that we buy, as far as like what's the future redevelopment opportunity, like anything we look at, it's got to make the most sense today as in its present state. So if it's a mobile home park, like we're buying it for a mobile home park, and if God forbid 15 years down the road, the path of progress comes through there and now it's prime land and it's got a higher and better use, it's kind of icing on the cake to us. And I don't think that's as prevalent in the mobile home park space as it is in parking. So going over to parking here, that is one of our criteria. Like number one, it's got to stand alone on its own today as parking. We got to know that we feel very confident in the parking demand, not just today, but 10 years from now. That it's got to make sense as a parking asset. And we basically look at it as like its use today as parking is the lowest use that it's going to ever have, meaning that it's on an irreplaceable piece of land in a fast-growing, thriving market, knowing that whether it's 10 years, 15 years, 20 years, whatever that time frame looks like, we'll operate as parking until the point comes where it's got a higher and better use as something else to where, we knock it down or build on top of it, whatever it might be. But it's still icing on the cake. We don't underwrite that value. We don't, take that into consideration, other than we just have to know that at some point, based on the proximity to all the other growth and what's happening, that it's very impossible to lose today because it's already operating, but even 10, 15, 20 years from now because of what's happening in that marketplace. So anyway, but we don't necessarily put any future development value there. We don't try to underwrite that or put a number to it.
Which I have to imagine is pretty attractive to your investors, knowing that, hey, this is what our buy box is, and this is what we're sticking with in its current use.
That's it. I can't promise tomorrow. I can't promise it. But what I can promise you that if it goes how I think it's going to go, you're already going to be happy, but you're going to be incredibly happy, right? And so I can't promise that even if that doesn't happen, I can promise you that it will be a solid parking asset for whatever that run might be, 10, 15, 20 years. Like it makes a ton of sense for parking as it sits today. That's what we're investing in is today, not necessarily 20 years from now. But again, feel very confident, not 100%, but very confident based on all the other dynamics in place that it inevitably will. The value of that land will be there today. It'll be there 15 years from now or 20 years from now. Maybe not as parking, but as something else.
Absolutely. Yeah, just based on the locations and your criteria,
That's right.
definitely makes sense. Kevin, with what we've experienced, what a lot of people in the space have experienced over the last year or two, it feels like it's been much harder to raise money. Have you experienced that in the asset classes you've been, or how has it been going out and raising money for the funds that you've operated?
It's a great question, and I don't think it's asset class specific. And I will say that it's been hard. I'll simply put it's been harder. If I had to actually put a value on how much harder, I'd say that if I had to measure, I'd say it's probably 5x harder than what it was to raise the same amount of money. With that being said, I'm very grateful for the position we're in, and just I had this conversation earlier today. We were I went through 08. I lost a lot, learned a lot, and just vowed to, like, I didn't want to have to rebuild it a third time, right? So the second time around, like, let's be more conscious that real estate's a long-term game. You can make short pops here and there, but it's a long-term vision, and trying to build a business model entirely around a 3 to 5 year exit, which is what really started happening with a lot. I'll use multifamily because it's the one that is experiencing the most pain. You got these like short-term business plans, and right, like that's like musical chairs. Inevitably, at some point in time, the market will shift. In this instance, it was rates, right? It could have been something else, but the market's going to shift, and it's tough with that short-term vision. And so we've always looked at things much more conservatively. And while I guess in the short term, that's not as great for ROI to our investors, meaning that, if we're going to go into a deal and we could have gotten 75% leverage, but we're going at 60 or 65%, right? The cash on cash return is not going to be as significant. On top of that, the longer you hold an asset, the lower the IRR goes. And so, most folks are looking at 5-year pro formas, and that's kind of what they're measuring the projected IRR off of, where we like to hold things for 7 to 10 years. And so if someone's only looking at the IRR, then they might say, well, this other deal is a much better deal than that of what, Sunrise and Kevin Bupp is offering. However, with all that being said, we had a lot of capital trying to come our way in 2020, 2021, 2022. And if you had to look at our business, if you had to bifurcate Sunrise Capital of what I do and what my business partner, Brian Spear, does, he basically handles the capital raising side, regulatory and compliance. So he's on that side. He's on that side of the financial house, runs the finance side of the house. And I'm on the acquisitions, but then also I oversee the operational aspect of our vertically integrated property management business and the asset management of the parking stuff. And so there's like this, there was this push pull when there's a lot of money trying to come in, and Brian's like, Kevin, like, I got so many investors, they're going to go somewhere else. And I'm like, I don't know what to tell you, man. I can't get deals to underwrite. Like, I can't financially engineer this thing to make sense. And so for that reason, I'm not going to buy. And that's a really difficult thing to do when everyone else is scaling to the moon. And you start to question yourself. I'm like, what the hell do these other folks know that I don't know? And I think in some instances there was something else they knew and I didn't know it, right? Like there was maybe another dynamic there that I just wasn't taking into consideration. But I think for the most part it was a short-sighted, opportunity for a lot of people. Get in, rising tide lifts all boats. Get out. You might not have to execute in a business plan, maybe do a rent increase, and that you can flip it in a year and a half or 2 years. But like that's a short-term vision, and that's ultimately got a lot of people in trouble. And so we didn't buy as much in those years, 2020, 2021, 2022, but we also never stopped distributions. And fast forward to today, we still haven't stopped distributions. We're in a really good position. We have no variable rate debt. We have no bridge debt coming due. We got low leverage across the board. We got a good deal of liquidity. Our investors never stop seeing their distribution checks. And so for that reason, it put us in a really good position, I think, to raise money. While a lot harder than what it used to be, we still, in the track record, we can kind of really hinge back on that. Like we don't have any deals that are going sideways. Everything's in a really good financial state. We've got a great deal of liquidity. In the event that we did have any internal issues, we had a lot of liquidity on hand. And so it's just, I think that's definitely made it a little bit easier maybe for us than other folks that have had some deals go sideways to raise capital. But bottom line is it's way harder. People have trepidation. I mean, a lot of retail investors have lost some money. Maybe they lost all their money. I just don't, they've made, decisions that haven't panned out. And there's just uncertainty. The average retail investor is less sophisticated than maybe an institutional type investor. And so while they might be smart, it's hard to weed through all the noise that's out there. Right. And they're seeing that there's now more challenges than there are good things. And so they're kind of just like holding back. It's like, okay, I don't know what's happening. It's unsettling. There's an election happening, right? There's all these variables coming into play, and I don't know how to actually measure it. So for that reason, I'm just going to hold my money for the time being, and I'm not going to invest it anywhere. So I think there's a lot of that going on as well. And just all that, the culmination of all those things has just made it inherently more difficult to raise capital, at least from the sources that I think you guys and also we raise it from, which is, that retail capital group.
Yeah. No, we talked a lot about pros and cons. There's always a yin and a yang to everything. And this is true when it comes to deals and money, where when the money is everywhere, there's so much competition, it's hard to get deals. And then when there's actually deals, you mentioned the last couple of years have been good for you as far as acquisitions, it's harder to raise capital. And those two are very inverse of each other because it has a lot to do with the sentiment of the masses, right? So it's
true.
Yeah, all that to say, thinking back, in your own business before you were as established as you are now, a problem Mason and I have had, when you're new or newer, I'm about to hit 7 years in, which is still relatively new. You do what you have to do to get the money to do the deals. And so sometimes you give away large portions of deals. And something that, again, Mason and I have run up against is we need a whole new set of investors, basically. It's a different avatar. It's that, accountant or professor or doctor who works like crazy, has a family, and just wants to set their money and forget it. And so how did you go about, when you were newer to the mobile home park side of things, identifying your avatar, targeting them, and raising money when you didn't have decades of experience?
Yeah, I mean, that's a good question. I guess you could say, first and foremost, I guess I'll start from the standpoint of the mobile home parks. Prior to that, I had 10 years of experience, right? I had lost a lot and I had to kind of rebuild after 2008. But with that being said, I still had a number of private lender relationships that had lent lots of money to us, more of like on a debt side, that I kind of carried over from the single family space. So I had some relationships there still. Friends and family for the most part. After 2008, I had my credit. I stopped looking at how bad it was. I mean, it was probably under 500 for 10 years, for a very long time. As I just dug myself out of like just the chaos that had occurred in those couple of years. And so I had for me, the biggest thing that I kind of that I leveraged to raise capital was just prior experience, but also just my laurels and just being excited about the opportunity, be able to very articulately convey what the opportunity was, a business plan, and how it was such low risk for anyone that was going to put capital into the deal. And so it initially started with, private investors that had lent money to us on single family stuff. They had a lot of trepidation because number one, they're used to single family stuff. Number two, most of them had only lent locally, meaning like here in a couple counties around me in Florida, whereas now we're buying stuff in North Carolina and Georgia and all over the place. So that was a big hurdle for them to get over. Friends and family always had beliefs in me, although they still had, reason for concern because again, had a challenging prior years. But I think just being able to, clearly convey whatever your business plan is, and being very confident about it. Also having some of your own skin in the game, I think is very helpful. And like in the mobile home park stuff, I didn't even try to raise capital really until we did the first couple of deals. Like I basically used my own money. I had one partner that came in and we had a couple private lenders, like on the debt structure. And we did the first 7 parks in that manner because I didn't want to take any capital. I actually didn't want to bring in any outside capital until I knew I could prove the asset, the business model, and work out any potential kinks and just show like, hey, I'm risking my own money, the little bit I have that I've been able to save from the banks taking it from me or whatever from 2008. And I'm building this business and I believe in it. I'm risking everything I have to make it happen. And only then did I feel comfortable actually going out and taking capital from the outside world. So again, everyone's situation is a little different. That was mine. I think that's really how I was able to, I guess, I call it phase 2 of my journey of truly rebuild, even with a tarnished, prior decade of losing everything in 2008 and having to rebuild again, just being confident and also just knowing more about whatever your business model is than most others and just being able to clearly articulate that to potential investors. I think that takes you a fairly long way. Anyway, I'll leave it at that.
Yeah, no, I love that because as someone that when I got into real estate, started listening to Bigger Pockets and a lot of these different podcasts that talk about scaling to the moon, raising investor capital day one, low and no money down, really short-term time horizons for building huge businesses. At this point, I can say I think a lot of that is misleading. And the reality is it's slow and steady iteration, getting really good at your niche and knowing it better than everyone else, putting your own money that you have in at first and learning and being in it for the long term, just taking hey, this is a 10, 20, 30-year pursuit. And then year 5, 6, 7, 8, you start to get some traction and really build the confidence with people around you to invest money with you, as opposed to trying to go raise huge sums of capital 6 months into trying to start a multifamily business. So.
Yeah, I know. I get it. Yeah, no, I mean, honestly, I still to this day, we've got we've got great investors, but to this day, I feel a lot of pressure, and I guess everyone's a little different. There's a lot of pressure I feel when every time we bring money in from an investor, because I think about they worked really hard for that money, right? Like they believe in what we're doing. Again, I can show a track record of what we've done, so I feel very confident in our ability to perform and execute. But even then, even with all that, there's still like a pretty heavy weight. And I don't think it's for everybody. I don't think going that route or going the route that you guys go or we go of raising outside capital is for everybody, because it truly is. If it's not a burden on you, then you probably also should not be raising capital. If it doesn't concern you or just give you an element of stress, however big it might be, then you probably shouldn't be taking capital from folks in anyway, because it is a burden. You're taking their livelihood that they've worked really hard for. They're relying upon you to go compound, that hard work that they put in many years prior to help them and their family, live whatever lifestyle they want to live. And so, to me, I take that seriously. And honestly, when we start bringing capital from the outside, I actually tried to stave it off for probably a couple of years. Because what ultimately occurred is we were doing these mobile home park deals, and I was I've been running my show for almost 11 years, my podcast. And I would talk about, early on, I would talk about just the random stuff, the deals we were doing, how we found it, the challenges, how we're financing it, just all this random stuff. Just because for me, it was like cataloging the journey a little bit. It was also, I figured someone out there might want to hear what we have going on, but I didn't say, we're raising capital, we'd like to bring in investors. I didn't say that, but I'd have people reach out, say, hey, I like what you're doing. I'd like to put some money with you guys. And I'm like, although we could use it, I could probably find a home for it. I just don't feel comfortable doing that. It's just not now. Call me back in a year, call me back in 2 years, what have you. And then we finally, decided that probably is the way to get from where we had started to just building a more sustainable business, like an organization, not just myself and another partner kind of battling it out, which is fine. But we wanted to get to really had a vision to get to a more sustainable company, one that in 10 years could potentially run without us, right? That could continue on and just be a legacy company that goes on for many, many decades. And the only way to be able to get there, in the duration that we wanted, was to actually start bringing in outside investors to help us get there.
And it's this delicate balance you're always going to have of, okay, do I need to scale for the sake of my ego, or is it the logical next step in my business? And then the fiduciary responsibility you have, and just the stress of managing investor capital and everything like that. And I think ego comes into it a lot of the times of, I want to grow to the moon, and you hear everything and comparison, it's a thief of joy and blah, 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 all these different other things you can say, but it's
absolutely
difficult line to walk.
I will tell you that I made more money in my pocket money from from the first 7 deals I did with my own money, risking not bringing any outside investor capital other than like a debt partner. But I made more money on those deals in the grand scheme of things than I've probably made in the last 7 years of what we've done with Sunrise. And we bought, $300 million worth of assets, right? Because it's a long-term game. I mean, we're just now in the promote. In the first 2 funds we did. We're on fund 4 right now, but we're literally, myself, my partner, are literally in the promote on the first 2 funds that we did, but we're not in the promote yet in our 3rd fund. And we're still raising and buying on the 4th fund. And so realistically, the stuff we're buying today, we actually won't really reap true benefits, meaning that we've got all investor capital paid back. And we're really in the promote for another probably 7 years, maybe even 8 years, right? It's a really long-term strategy. And so, scaling isn't necessarily for everybody. For us, I want to build an organization that we're able to have multiple layers of folks that are smarter than I, that can help just do better than what I can. For example, I'm good with operations, but we've got a director of operations. I'm above him, so he reports to me. But that guy's a rock star. He's built organizations, mobile home park organizations from like 2,000 pads, like 20,000 pads in the period of 6 years. Like, I've never seen that. I could probably figure it out, but it's like second nature to him, right? Like, he's just an operationally driven guy, and that's how his brain thinks. I'll never be that good no matter how hard I try. Our CFO, I know basic financing and bookkeeping. I sure as hell am not qualified to be a CFO or to think about forward tax planning strategies and things of that nature, right? So bringing these folks in is for us is critical to build a sustainable organization that can outlive us. But the only way that we could get there is by having a large enough company that has enough revenue to be able to afford those types of folks. And so for that reason, scaling made a lot of sense to me, even if it's more delayed gratification from the general partner standpoint, knowing that I'm not going to get paid for quite some time, which is fine. I'm completely okay with that. But again, a lot of that started like what I have today and what I've been able to live on and reinvest. We're LPs in our deals too. So, but a lot of that money and that wealth was created from deals I did by myself, and they weren't large scale things. I mean, a fraction of the scale that we have as an organization. So don't scale just to scale. Don't do it because like your ego's telling you to. It's not necessarily the better thing to do. In fact, if anything, like you'd probably make more money in the short term if you just went and figured out how to do a couple of deals on your own, even if they're much smaller scale. Maybe that doesn't, stroke your ego as much, but it will definitely look better in your wallet and your pocketbook, probably.
Yeah, absolutely. There's a lot there I want to unpack really quickly. It's you need to figure out how to make your own money before you start taking other people's money, because you're going to make more, and then two, it's just stressful and you can get yourself in a lot of trouble. And then when you're building an organization, you have the systems figured out and you're scaling. You're going to need to find people that are better and smarter than you in their individual niche to come in to help you manage it and help it grow. And Kevin, it sounds like, to put it lightly, you had a rough time in 08, 09. And I'm sure there's a good amount that you learned from that. But, outside of kind of a black swan type of event, what are some of the, biggest ignorant debts that you've paid down over the years that you wish you had known, 15, 20 years ago? Because there's a lot of lessons I'm learning right now that I'm going to be so grateful for in a decade. But right now I'm like, oh God, this sucks.
Yeah, no, I mean, if I had to compare like, today in our business versus '08, I think a couple things that stand out. Number one is just conservative leverage. And we weren't, I don't think that we were outlandish back then, but I mean, we're very conservative today. Again, it's not going to yield the highest returns, but I know that no matter what will happen, that our leverage point's so low that our investor capital is safe, we're safe, and we can ride out any storm. On top of that, and kind of in the same manner, having liquidity, having operational reserves. Back then, we had operational reserves that we thought were sufficient for when times were good, as they seemingly were for many, many years. But definitely, there's an enhanced operating reserve policy we have in place today. And it's not necessarily a formula per se, but it's more than just like 3 months of like, operating capital, and we do things more on a fund structure. So it's a little different. We look at it individual property wise, but we also kind of roll it up into a fund, and we don't distribute every dollar that we possibly could to our investors. We like to have liquidity. And we've had even more so over we've never stopped distributions. But however, there was instances where in 2020, 2021, we probably could have distributed more, but we chose to keep it in the event, that, this thing, rates would go up. And again, I didn't have a crystal ball, but I just better safe than sorry. And I'm glad that we did. And so liquidity, you could ride out any storm. Like you truly can. If you look at historical trends, real estate always wins if you can hold on long enough. And so, but you got to be able to hold on long enough. And the only way you can do that is if you actually have the liquidity to do so. And I don't know the exact number of what that is for every person listening, but I say for us, we could very comfortably go probably a year and a half, knowing that we've got the necessary reserves. We don't have to make a capital call, and that we could ride out the storm. The storm lasted for 10 years, and it's like the whole world shut down, like a COVID times 10. I'm not sure about that, but if everyone's in the same scenario, then it's probably not as much to worry about, right? But liquidity is king when it comes to challenging and turbulent times.
Yeah. Every investor who's been in the business for decades has said that to me over and over again. So I think re-listen to the last couple minutes, guys, because it's easy to want to leverage and use every dollar when things are good, but that will not go on forever. So Anyways, well, Kevin, as we head towards the end of the show here, we like to ask everyone, we'll give you a moment to talk about your business and where people can find out more about you. But are there any questions we didn't ask that we should have, or you wish we would have?
I don't think so, guys. I mean, I think you guys did a great job. I mean, I think we covered a lot of ground. Any specific questions that come to mind? No. I think I just leave it with like this parting thought is that no matter what's happening in the current economic cycle, like generally speaking, if you understand the basic fundamentals of whatever business you're in, again, there's a million and one different ways to make money in real estate. Master and hone in on your one area that you just thrive in, that you understand better than anyone else. And if you don't stray from the basic fundamentals and principles of that model that works, then you should be able to make money in good times and in bad, no matter what the interest rates are or what they're going to be or where they're going to. Like you should be able to, and maybe during parts of that roller coaster cycle, like you'll make more money than others, but you'll be able to have a sustainable, practical business that will, hopefully outlive you even. So I think just not being disciplined more than anything else. And it's tough. It's easier said than done. But try to maintain discipline throughout, no matter what part of the economic cycle that you find yourselves in. And again, don't stray from the fundamentals. And I think that you'll find a lot of success. Again, doesn't matter what the vehicle is. Just you got to be true to yourself and true to whatever that niche is that you chose.
Yeah. Yeah. And a big part of that is being okay with, I'm going to work at this for 10 plus years, not, I'm going to scale to the moon in 1 year and quit my job. So, yeah.
That's right. That's what, having that long-term plan, what I've always found and what I've seen, you got the 10-year plan, but there's going to be, if you're just true to yourself, there's going to be some point in that beginning, you probably in the first 5 years where you'll hit one of those pops, right? We'd be like, oh, that was nice. Like, I'm going to stick with my plan. I'm a steady Eddie money, long-term vision, but you'll probably have an opportunity somewhere in there to get this little, booster rocket of a deal, right? That just, does 5X of what maybe that long-term plan looks like. And that's so like, but if you stick with it and you literally just have that long-term vision, inevitably those little pocket deals or those, I call them booster deals, they'll come inevitably. I mean, you guys, I'm sure that there's probably a couple that come to mind right now as we're talking about that, about this, that in your business, you've had a couple of flips probably that was like, man, we average, on 10K a flip. And this one, oh my God, like we literally made $75,000. That literally, we made 7X or whatever it is. I'm sure you have a few that come to mind that just knocked it out of the park, and that will happen. And just don't expect it to happen. It will inevitably come with time.
Yep. You tend to get lucky when you're always participating.
That's right. I love it.
Yeah. All right. So you've got a great podcast. Tell everyone about what all you're doing and where they can find out more about you.
Yeah, so you can go to our company website if you want to learn more about what we do at Sunrise Capital. You can go to investwithsunrise.com and just read about us. We've got an offering up there as well, but we're pretty transparent. We got a lot of resources about the deals that we do. We even put like third parties up and stuff like that, like appraisal reports and phase ones. If you want to get all nerdy and nerd out on that stuff, you can go find some of that cool stuff there and just learn about the business and how we run it. KevinBupp.com is my personal site. I also host my Real Estate Investing for Cash Flow podcast on there as well. And I think lastly, my last name's unique enough in that if you just type in Kevin Bupp into the LinkedIn or Instagram or Facebook, you shouldn't have a hard time tracking me down.
Awesome. Well, Kevin, thank you. This was great. We really enjoyed all the insight and wisdom. But until next time, guys, Dan Habercost and Mason McDonald with the Big Picture Blueprint signing off.